Welcome to part 1 of our video series all about DSCR loans, companion video walkthroughs to our popular article series featured on BiggerPockets. If you are a real estate investor in rental properties from classic SFRs, the BRRRR method, short-term rentals, or vacation rentals, or thinking about investing in the future or learning more, these videos are for you. Make sure to like, subscribe, and save, as these videos are the ultimate resource guide for DSCR loans. In recent years, a fairly new loan product, Debt Service Coverage Ratio, DSCR loans, has become enormously popular with real estate investors. DSCR loans have become a critical tool for investors on track to achieve their dreams of financial freedom. These loans, meant specifically for investment properties, are so effective and popular because they require no income verification, or debt-to-income ratio, and no tax returns or endless paperwork. Further, while the qualification and documentation are much less than conventional mortgages, the interest rates are just barely higher, typically less than 1% more. These loans offer fixed rates for 30 years, including options where it's interest only for the first 10 years, so you avoid the payoff and refinance pressure that often comes with hard money alternatives. Put together, it's no wonder why investors have flocked to these loans to scale their portfolios and achieve their dreams of financial freedom. What is the definition of a DSCR loan? DSCR loans are mortgage loans secured by residential real estate turnkey properties, strictly used for a business purpose and underwritten primarily based on the property. How do you qualify for a DSCR loan? Potential borrowers can sometimes encounter confusion when first learning about DSCR loans. Specifically, the qualification process, especially if they have been put through the ringer with the long and arduous conventional loan qualification. While conventional lenders will scrutinize seemingly every aspect of your income, expenses, bank account transactions, and credit history, DSCR loans are different, as the qualification and underwriting are primarily focused on the property instead of you, the borrower. DSCR lenders will look at your credit score and make sure you have a few months of payments in the bank. But other than that, your property qualifies, not you. That means your income sources, whether you have a W-2 job, own a business, invest in real estate full-time, or are retired or between jobs, it doesn't matter. DSCR lenders strictly do not take income into account. What determines my rate and my terms? So what does determine if you qualify and what rate will you pay? It primarily comes from 3 key factors: debt to service coverage ratio, LTV or loan to value ratio, FICO or credit score, debt service coverage ratio or DSCR. It's no surprise that the DSCR metric is important for DSCR loans. The debt service coverage ratio measures the income from the property, rents, divided by the main expenses, principal and interest on your mortgage loan, plus property taxes, insurance, and any applicable HOA dues. Real estate investors generally invest for monthly cash flow from their rental properties, which is achieved when income exceeds their expenses and they have profit left over. A DSCR of 1.0 means that income equals expenses, and the investor is breaking even. A DSCR above 1 means the investor is making money as they now have cash flow. For example, a DSCR of 1.25 would occur if the property earns $1,250 per month in rent and has $1,000 in PITIA. A DSCR below 1 means that expenses exceed income, so the investor is losing money every month. How does this work from the lender's perspective? A lender will generally want the investor to make the most cash flow possible because the primary concern is the ability to make payments on the mortgage loan. Therefore, the higher the DSCR, the better lending terms an investor will get because the lender can be more confident of getting paid back as the rent more than covers the debt payments each month. Loan to value ratio, or LTV. The second determining factor is the LTV. This is a simple metric comparing your loan amount to the value of the property. This is extremely important for the lender because the lender's main recourse, if you stop paying or default on the loan, is to foreclose on the property and replace the money lost on the unpaid debt with the real estate asset. Simply, if the lender can sell the property for more than what is owed in a foreclosure situation, then the lender is protected from losing any money. As such, the lower the LTV, the lower the risk of loss for the lender, as they have a larger cushion in case foreclosure is needed. For example, in an 80% LTV scenario, say a borrower purchases a property and puts 20% down. A $1 million property would carry an $800,000 loan with a $200,000 cushion, or equity for the borrower. In this situation, if the borrower defaults and the lender needs to foreclose, as long as the property hasn't declined in value by more than 20%, $200,000, the lender is protected against the risk of loss, since they would then owe a property with more than the canceled debt. In this example, if the property maintained this value of $1 million and the lender foreclosed due to the default, the lender actually comes out ahead, owning a $1 million property instead of an $800,000 note. However, in the real world, it's not so simple, as all real estate investors know very well, as there are closing costs, legal fees, and time and energy spent in this process that nearly all lenders would prefer to avoid. So how does this affect borrowing terms? Simply, the lower the LTV, the better the terms for the borrower, as it increases the cushion for the lender in the case of declining value in foreclosure. In the previous example, the value of the property would have had to decrease by more than 20% for the lender to lose money, an unlikely but plausible scenario. However, if the LTV has been 60%, a $600,000 loan on a $1 million property, the value would have had to decrease by a whopping 40% or $400,000 for the lender to be in a loss position. Much more likely. Thus, the lender can offer better terms, like a lower rate on the 60% LTV loan as it carries much less risk. FICO or credit score. The final key metric towards qualifying for a DSCR loan is your FICO or qualifying credit score. Typically, there are 3 credit scores for everyone: Equifax, Experian, and TransUnion, and the score used for qualifying for the loan will be the middle one. While DSCR loans are primarily based for the property rather than the individual borrower, the lender is still looking at credit scores as part of the big picture of qualification. Note that the credit scores from a mortgage lender will be calculated a little differently than the score you may see from a normal bank or online data provider. These scores are weighted a bit more heavily towards real estate credit, taking things like other mortgage debt more into account. From the lender's perspective, someone with a long and great history of timely and full payments on other mortgages is a great indicator of the likelihood of perfect and timely payments on your DSCR loan. So the better the credit, the better the terms. Other factors that determine qualification. While the big 3 metrics reviewed earlier are the main determinants of your qualification rate, other factors make a difference as well, albeit not quite as important. Some other factors that DSCR lenders utilize include loan purpose. Typically, you will get better terms on an acquisition than a cash-out refinance, as the value utilized by the lender is more certain on a purchase and there's more guaranteed skin in the game for the borrower. Loan size. DSCR lenders typically like a Goldilocks sweet spot loan size, not too big and not too small for the best pricing. This is because there's less of a market for supersized rental properties. How many potential borrowers or renters are there for $3 million mansions? But conversely, a too small value property worth $200,000 or less may indicate a declining or ultra-rural market, a rough neighborhood, or a property in poor condition. The best rates and lowest fees typically come in the $250,000 to $750,000 loan amount range. Prepayment penalties. DSCR lenders are known for giving the best rates when penalties for prepaying the loan, a fee if you prepay early in the term, or higher. If you are a long-time horizon investor and don't plan on selling quickly, it's often a good idea to trade prepayment penalties within the first 5 years for a much lower rate. How to pick a DSCR lender. Once you're ready to take out a DSCR loan, it's time to pick the lender that's right for you. It can sometimes be overwhelming to figure out how to start and who to pick. There are lots of DSCR lenders out there offering the product. Here's the secret about DSCR loans that not a lot of lenders will tell you. The loan product is mostly the same among all lenders. While there are some differences along the edges and with exact interest rates most of the time, the loans are more or less the same. And when it comes to rates, one lender may have the best rates at a given time, but as in all competitive markets, it won't last for long, and rates will eventually converge to essentially the same. So how do you pick the right DSCR lender, not just for your immediate deal, but for establishing a long-term relationship? You are going to want to hone in on the true specialties and differences in loan programs offered and the reputation and financial strength of the lender as well. Rates and fees are likely to end up being pretty similar, so make sure to ask good questions and find out why they are different. Easy Street Capital is America's best DSCR lender because of our great interest rates, our flexible options for some of the stretchiest scenarios, and underwriting guidelines and qualification questions that follow common sense. If you are interested in learning more, please review all the helpful links and tools in the caption below. And make sure to like, comment, and share this video if it's helpful.